Hello, my fellow stock trading masters. This is Lance Jepson with GorillaStockTrading.com. The Dow has a weak downtrend rating. The S&P 500 has a weak downtrend rating. The Nasdaq has a weak downtrend rating. And the Russell 2000 has a downtrend rating. The Heikin-Ashi on the S&P 500 gives us a red brick or a sell signal. The Renko does not confirm. It gives us a buy brick. So we have to throw the Heikin-Ashi and the Renko out this week. No signal. No institutional buying or selling was detected on the tick last week. The percent of stocks on New York Stock Exchange that are trading above their 50-day moving average is at 15%. That's horrible, folks. That favors the bears. The percent of stocks on the New York Stock Exchange that are trading above their 200-day moving average is at 20%. Again, folks, that's horrible. That favors the bears. Money came out of stocks. Okay, right about here is the 31st. Okay, money came out of stocks and it went into bonds. Barely, but still. Biotechs are still within a weak downtrend, and they have fallen back underneath the 200-day moving average. But really, guys, they're just kind of bouncing around that 200-day moving average and testing it. Okay, so we need to wait for resolution off that 200-day moving average to get a better signal. But nevertheless, this high is lower than this high is lower than this high. And so you've got this, sequence of lower highs. You have the 50-day EMA falling. Okay, you've got the 200-day flatlining, folks. This favors the bears. We are still not at a risk-on market. The Ichimoku on the Russell 2000 green cloud still favors the bulls. The NYAD to the S&P 500, you could see that the S&P 500 has, from Monday, August 31st, you have this, clearly it's down. On the NYAD, it's down also. You had a positive divergence, though, earlier in the week, but then you could see big gap down, and the candle is basically at where it was on September 1st or Tuesday. Okay, and the S&P 500 is pretty much doing the same thing. So there's not a big enough divergence to favor either the bulls or the bears this week. No signal. The McClellan oscillator on the New York Stock Exchange is at negative 0.7, but folks, that's so unbelievably close to zero. We have to throw it out this week. No signal. The pivots on the Russell 2000, it's underneath the pivot level. Folks, that favors the bears. The S&P 500 high-low index, look at that unbelievable plunge. Red falling, little blue, little smidgen sideways line there, but not enough to negate this big red drop. Folks, this clearly favors the bears. The percent of stocks on S&P 500 that are trading above their 50-day moving average with our EMA envelope lines, it's below the EMA envelope lines. The EMA envelope lines are falling. Folks, that favors the bears. The S&P 500 to XLI, they're both tracking very nicely. They're both right on top of each other. No divergence between the S&P 500 and XLI. No signal this week. Our sentiment indicator, okay, it's way below the red bearish sentiment line. And even though it's broken back above the negative 100 line, I warned you guys about that a couple weeks ago. I said, hey, listen, even though it's broken above that negative 100 line, I don't trust the CCI because we're so far underneath this bearish line. Well, that's exactly what happened. And look at how it's gone above, it's gone back underneath, and it broke above it again this week. Now it's rolling over again. I mean, it's just banging around that negative 100 line, folks, which means no clear signal on our sentiment indicator this week. The S&P 500 to high yield debt, they're both tracking very closely. No signal this week. The other system applied to SPY in the daily time frame gives us a blue high-low bar or an indecision signal. The other system applied to SPY in the weekly time frame gives us a red high-low bar or a sell signal. Because we do not have confirmation in both the daily and the weekly time frames, we have to throw the elder system out this week. No signal. The PPO applied to SPY, it is banging back and forth on the histogram bars above and below the zero line. It's just oscillating almost right around that zero line, folks. Okay, and you could see that we've got the green and the red lines here just right on top of each other going sideways. That means there's no clear signal. We have to throw it out this week. The VIX short-term futures within an uptrend, and that favors the bears. The VIX midterm futures, again, within an uptrend, that favors the bears. Our NYAD, we do not have a blue high-low bar, which is our elder system applied to the NYAD, and that's our signal. Looking at the S&P 500, I wanted to go back a little further so you could see these support areas that I drew. And you could see that the market, went underneath, then went back above, then rolled over and went back underneath. It's hard to get a signal out of that, folks. And then if we come down to the stochastic, you could see that we're right in the middle of the buy zone and the sell zone. Okay, just under 50. So again, that's kind of a neutral rating. We have no clear signal there. The ADX line still has the negative DI line on top, and the white ADX line is still rising, which means the market is trending down. Folks, no clear signal this week. We have to throw this indicator out. Folks, my rating for trading next week is sidelines. The bulls and the bears are just too evenly matched. I feel that the bears have just a slight upper hand over the bulls, but not enough to give the bears the advantage over the bulls. It is best to be on the sidelines and in the safety of cash. If you go to make a play, okay, stay in the trade very short, only for a day or a couple days, and then jump out. Okay, that's what a sidelines rating means too. It's a fairly quiet week next week for fundamental economic data. On Wednesday, September 9th, the Bank of Canada announcement. Now, parts of Canada have gone into a recession, so it's going to be very interesting to see what the Bank of Canada does. If Canada devalues, right, their currency, then that's going to, again, put an upward pressure on the U.S. dollar. Since Canada is such a commodity-based economy, they are more susceptible to deflation. I believe that the Bank of Canada announcement next week is something that you should follow closely. Then on Thursday, September 10th, the BOE announcement and minutes and jobless claims. And then on Friday, the PPI. Now, guys, you probably heard Kim Davis, the county recorder, got thrown in a Kentucky jail. Okay, the county clerk for refusing to sign her name on a gay marriage license. Okay, so they basically threw her in jail. She said, "I'm not going to sign my name on a gay or lesbian marriage certificate where it says my name because, I know very clear what the Bible says about gays and lesbians, and I feel convicted about it. I don't want to put my name on there like I'm authorizing them to be married. I don't want my name associated with that." Okay, so they threw her in jail. Now, what about all of the heterosexual couples that were waiting to get married by her? Okay, so you just go throw her in jail. So basically, if gays can't marry, then no one can marry. What's pretty sad about this is that, the political agenda by Democrats to redefine marriage for 95% of the population, for the estimated 5% of the population who identify themselves as either gay, lesbian, or transgender, okay, that's a bad move. Or, to take a 5% niche and force it onto everybody else and redefine all of marriage for 5% of the population? Are you kidding me? What low IQ person in government thought that would be a good idea? You know what I mean? But now we actually have the government throwing people in jail. Okay? Now, Now, some of you might want to say, well, Lance, aren't we all God's children? Doesn't God just love everybody? Well, my take on that is, why don't you go ask God that? You know what I mean? Why ask me that? Right? Go look in your Bible if you want to know what God says about that. You know what I mean? Go get down on your knees and pray about it. And you ask God about it, right? God is the one that says that he will judge, not me. So why would you go around saying, well, isn't everybody just God's children? Oh, so you know the mind of God now? You know that everybody's God's children? You know this? You know, pompous comments, guys. And minus that obvious, okay, taking religion out of it, why are some people so willing to say, well, she's not doing her job. She's a county clerk. It's the law of the land now that gays can be married. She's not signing the gay certificate, so she should go to jail. She's not doing her job. Okay, but why is it that you would sign on to a horrible socialist, borderline communist government throwing people in jail for not doing their job? You might work in the private sector. Does your boss have a right to throw you in jail when you don't do your job? Okay, when you kind of slack off or you call in sick one day when you're really not, okay? Do you go get thrown in jail, right? So in other words, you're willing to have big brother, big government, throw your fellow citizens in jail, and you're ready to sign off on that and give that the pass because Kim Davis is a Christian? Really? Really? How easy it is to get you to sign on to the government throwing your fellow citizens in jail. Boy, you are a pushover. You're really easy to get on board with the propaganda, right? But guys, think about that for a second. Jail is supposed to be where you put somebody that may be harmful or cause harm to other people. That in society, you put somebody in jail because maybe they're a thief and they rob people and they take money from people. You know, maybe they hurt people, they damage people, or they murder people, right? I mean, that's why you're taking them out of society and you're putting them into jail. You're locking them up, right? What crazy world do we live in where Kim Davis, a Christian, gets thrown in jail? Really? What exactly did she do to warrant the government stepping in and throwing her in jail? How is she threatening to anybody else and causing harm, bodily harm, or stealing or doing anything to anybody else? Other than practicing her faith, saying, I'm not going to sign my name to it, those gay couples can go and drive to another county and be married by somebody else, right? Okay? But no. As soon as one of the gay people heard that Kim Davis did that, they called in the liberal media, and the liberal media was all over her, right? Making it a big deal. Coming there with cameras. How come you won't marry gays? How come you won't sign it? Right? Like there's really that many people in that county in Kentucky. Like the population is really that great that would warrant all the press coverage, right? So, see, that's the problem when government becomes too big and oversteps its boundaries, okay? It's not a good idea, folks, to disobey God. God will take action, and when he does, that's always a scary thing. Okay? Now people say, well, but Lance, God loves us all. Aren't we all just God's children? Well, obviously, you don't have a relationship with God. You don't have a relationship with Jesus Christ if you even ask that question, right? You have no idea what the Holy Spirit is, and how when you lift up your life to a higher standard, that you could feel the Holy Spirit come into your life and that you have a relationship with Jesus Christ. Obviously, if you're asking that question, doesn't Jesus just love us all? So all people should just be gay and be allowed to marry, and we should redefine marriage and because God just loves them all? You know, you need to go and read your Bible. And obviously you do not have a relationship with Christ in the way that many other Christians do. Okay? Now, guys, the ACLU is a farce because the ACLU, which claims on its website to be, quote, our nation's guardian of liberty, working in courts, legislatures, and communities to defend and preserve individual rights, unquote. So where was the ACLU defending Kim Davis, right? That's all Kim Davis did. She executed her individual right that when she got hired on, there was nothing that said that she was going to have to, as a county clerk, sign her name to something that she views as disgusting, such as gay and lesbian marriage. Okay? She got hired on, and that was not part of the job, right? So she says, no, I'm not going to do it. I'm exercising my religious freedom to not be a part of that. I'm not going to put my name on that. Okay? Now, where's the ACLU sticking up for Kim Davis? Doesn't Kim Davis have a right to do that? Right? So in other words, the ACLU's purpose to preserve individual rights, okay, is not really about preserving people's rights at all. Okay? The ACLU is a Democrat group only protecting the rights of people that are in alignment with their political ideology. Okay? That's what the Kim Davis situation and the ACLU tells you. In fact, the ACLU is the one that wanted Kim Davis thrown in jail for a year, which she was. Okay? The ACLU called Kim Davis in contempt of court. Okay? They're the ones that moved in. Why would the ACLU side with 5% of the population over 95% of everybody else? Why would the ACLU be more interested in defending gays marrying in that county when they could just drive to the next county? Why would they be more interested in defending gays and lesbians, okay, than they would Kim Davis? Think about it. Think about it. It's all a political ideology. Okay? Personally, I have absolutely nothing against gay and lesbian people. I know a lot of them, and they're just as normal as anyone else. Okay? I have nothing against it. Okay? But I know what my Bible says, and God scares me, and I don't want to get on the wrong side of God, and I want to feel the Holy Spirit in my life, and I don't want to be a part of any of that. Okay? Now, I think Kim Davis, should have stepped down and left her job. You know what I mean? Okay, I think that would have been I think Kim Davis kind of messed up, and I hope they let Kim Davis out of jail and that they allow her to resign as county clerk. You know what I mean? That to me would be the Christian way to handle that. But guys, I told you what a mistake it was to redefine marriage for 95% of the population for just a 5% gay and lesbian transgender niche. Okay, I told you that was dumb. Not even getting into the guy that created the philosophical argument and later went into economics as the greatest utility, right? Doing that which benefits the greatest number of people, minus the common sense of that, okay? What should have happened was that gays should have had their own category of union called he-marriage or harriage. And for lesbians, it should have been she-marriage or sarriage, okay? I told you guys that redefining marriage is just going to create anger among 95% of the population towards gays and lesbians. That the Supreme Court ruling wasn't going to magically make everyone abandon their faith and what what the Holy Bible says. Just abandon all of it and say, "Oh, okay, if the Supreme Court ruled that way, then okay." Okay, since when in America have we ever allowed the government to push us around? Why do you think we are the land of the free? Okay, we are a people that does not succumb to heavy-handed government very well. Okay, and through the short history of this country, whenever the government tried to get too heavy-handed, that has always ended badly and in the death of a lot of innocent people. Okay, so this was absolutely the wrong thing by Democrats, by the Obama administration, and by the appointees, the liberal-leaning, left-leaning appointees that Obama put in there in this court. Okay, very, very bad move. It's almost like they're purposely trying to stir up tension between straight people and gay people. I warned everybody that it was going to have the opposite effect of bringing people together. Okay, I warned people about that, and look at what is happening. Okay, so why the Fed is in a rush to raise rates, okay, has been a problem that has bothered me for many months now, okay? When the economic data is not that good, and yet there the Fed goes again, talking up rates, just ready to just raise rates, okay? The only reason to raise interest rates is to cool off an overheated economy with runaway inflation, right? And clearly we don't have that. So why is the Fed still in a rush? Well, I came up with a theory about actual GDP crossing above potential GDP, and I did a show on that several weeks back. But folks, I've just come up with a new theory that's much more simple and much more elegant, okay? The problem with my actual GDP crossing above potential GDP is that I had to fudge a lot of numbers, versus using real GDP and nominal GDP to get the outcome, to get the numbers that I actually wanted. Okay, and my logic for doing that was, well, the Fed fudges, so I'll fudge the other way. That's not extremely solid logic. So I've continued to study it and look for what could be the reason for, an alternative reason for why the Fed is in a rush to raise rates. And I found it, guys. It's elegant, it's simple, and obvious. And no fudging of numbers has to be done. The current unemployment rate of 5.2%, okay, is pushing the Fed to raise interest rates. Why? Because inflation is dangerously close to spiraling out of control. Even with the disinflation from the rise in the U.S. dollar and the crash in the price of oil, the Fed views spiraling inflation as the biggest threat, and here is why. The Phillips curve was developed by English economist A.W. Phillips after a comprehensive study of more than a century's worth of data on unemployment and money wages in the UK. What Phillips found was that wages tended to rise when unemployment was low, but fall when unemployment was high. The reason? Workers press less strongly for wage hikes when fewer jobs are available, and businesses fight harder against wage demands when profits are low. To convey the idea of the Phillips curve, take a look at the aggregate supply, aggregate demand model in this figure. Holding the aggregate supply steady, we start at AD naught. An increase in aggregate demand shifts the AD curve upwards from AD1 to AD2, and eventually to AD3. The result is that the price level rises from P naught to P3, while output increases from Q naught to Q3. The increase in real output causes a fall in the unemployment rate as the price level is rising. This is the essence of the Phillips curve relationship, and I've illustrated that in this figure. The left-hand figure shows the theoretical inverse relationship between inflation and unemployment. But what is most interesting is that the right-hand figure appears to provide strong empirical evidence that the Phillips curve actually exists. In this figure, co-movements of the inflation and unemployment rates between 1961 and 1969 are plotted on the graph, and the points do indeed suggest a nice downward sloping Phillips curve. On the basis of this and earlier historical evidence, most economists came to believe that a stable, predictable trade-off exists between unemployment and inflation. The important policy implication is this: you can always use fiscal or monetary policy to expand the economy a bit more to reduce unemployment. The only price you will pay is a bit more inflation. Not a bad trade-off to keep people employed. But not so fast. Something very significant happened in the 1970s to shake economists' faith in the Phillips curve. If we add the data points for the years 1971 to 1979 to our figure, it blows up the Phillips curve. Check it out. Look at that, guys. That's freaking like a mess, right? If you draw lines connecting the data points starting in 1970 and ending in 1979, this is the mess that you get. It looks more like the Phillips curl than it does the Phillips curve. Clearly, this is not the typical downward sloping Phillips curve, but rather a much more chaotic Phillips curl. But wait, not so fast with throwing out the Phillips curve. Economists found a pattern in the Phillips curl chart above, and it is this. The series of supply shocks in the 1970s shifted the short-run aggregate supply curve leftward. This moved the Phillips curve rightward and upward from the green curve to the blue curve. But what about the red curve? Well, it's just a supply shock process in reverse. As oil prices fell back down in the 1980s, this and other positive supply side effects shifted the Phillips curve back towards the red line. Now, from a macro policy perspective, the virtue of this standard explanation is that it preserves the Phillips curve relationship. This means that in stable times and absent supply shocks, policymakers can still engage in discretionary fiscal and monetary policies to expand or contract the economy as they see fit. The only price paid is a little more inflation for a little more employment. This may be all well and good from a Keynesian perspective, but the monetarists have a very different explanation of stagflation and the events of the 1970s. Monetarists explain the Phillips curve like this. According to the monetarists, this disappearance of the Phillips curve in the 1970s may best be explained through the concept of the natural rate of unemployment and by distinguishing between a short-run and a long-run Phillips curve. It's important to note that Janet Yellen has Keynesian elements in her, she has classical economist elements in her, and she also has monetarist elements in her thinking. Today, indeed, the natural unemployment rate is graphed on the Fred website, and it's specified as the long-run natural rate of unemployment. Now, the modified Phillips curve theory of the monetarists grew out of the work of Edmund Phelps and Milton Friedman. The theory asserts that there is a minimum unemployment rate that is consistent with steady inflation. This rate is what classical economists and monetarists typically refer to as the natural rate of unemployment. Monetarists' major point is this. It is simply impossible to drive unemployment below the natural or lowest sustainable rate in the long run. And this assertion clearly implies that the long-run Phillips curve, or the LRPC, as you're going to see me use on the next illustration, is vertical rather than downward sloping. Now, why is it important that the Phillips curve is vertical rather than downward sloping? Well, because the policy implications of the monetarist natural rate theory strike to the very heart of Keynesian activism. Indeed, while the theory allows that a nation can use expansionary fiscal or monetary policy to drive unemployment below the natural rate temporarily, such a Keynesian joyride along the short-run Phillips curve must inevitably come at the price of rising inflation. Now, here's the economics behind a deadly inflationary spiral. If a nation repeatedly uses Keynesian policies to try and keep unemployment below the natural rate, the only result over the long run will be a deadly upward spiral of wages and prices, precisely like the one we had in the 1970s. Now let's use the monetarist perspective on the Phillips curve to illustrate how inflation can begin to spiral out of control if macroeconomic policymakers attempt to expand the economy below its natural rate of unemployment. This figure illustrates this process and pulls together Keynesian and monetarist theories to form the modern theory of inflation. Again, that's what I'm telling you guys, and I told you this in another show. This idea that Keynesian is on one side, and you've got the monetarists and the classical economists on another side, is a fallacy put forth by some perma-bears that really don't know much about modern macroeconomics, and they're certainly not economists. Modern economics, modern macroeconomics as practiced in today's form has elements of Keynesian, classical, and monetarist economics and theories in it. Now, here is the inflationary spiral, and here is our long-run Phillips curve, abbreviated as LRPC, and it's vertical. So this is the monetarists' contribution to the Phillips curve, So here you could see it vertical coming down. You've got your inflation rate on the vertical axis and your unemployment rate on the horizontal axis. Now, in this figure, we start at point A1, where the core inflation rate is 3% and the natural rate of unemployment is 6%, as indicated by the vertical line LRPC. Now note that from a political perspective, this 6% rate of unemployment is seen as unacceptably too high by a Congress and Keynesian president who, in an earlier decade, may have become accustomed to a 4% unemployment rate without inflation. So what do you think these policymakers are going to do? That's right. With voters growing angry over an apparent recession, they are going to engage in expansionary fiscal policy to reduce the unemployment rate to 4%. This is where the idea of adaptive expectations comes in particular, because people are assuming inflation will remain at 3%, they do not immediately demand higher wages, even as inflation rises above the core rate to 6%. This lag in wage demands allows the economy to move up the short-run Phillips curve to point B1, and the unemployment rate does indeed fall to 4%. Note, however, that once people finally figure out that inflation has risen and successfully demand higher wages to offset this rise in inflation, the short run is over. At this time, the rise in nominal wages brought about by successful wage demands shifts the short-run Phillips curve, PC1, out to PC2, and we are back to where we started at an unemployment rate of 6%. But of course, now we have a higher inflation rate. Now, frustrated again by the apparent recession, the politicians once again try to drive the unemployment rate back down to 4%, well below the natural rate. This works again in the short run as the economy moves back to point B2. But the Keynesian joyride doesn't last. With inflation now at 9%, people's adapted expectations eventually change, and we get another shift in the short-run Phillips curve to PC3. So we are back to the natural unemployment rate of 6% with even more inflation caught in a vicious inflationary spiral. So this is why the Fed is in a race to raise rates. The unemployment rate has just crossed below the natural unemployment rate. Here is the long-term natural rate of unemployment with the current unemployment rate. Okay, and as you could see, the unemployment rate has broken below the blue line here, the natural rate of unemployment. There it is, folks. Didn't have to fudge any numbers. There it is. Okay? And that's why the Fed is so worried about inflation spiraling out of control. Okay? Now here's the interesting thing, guys. Not only do we have the unemployment rate moving below the natural unemployment rate, we have Janet Yellen at the New Normal Monetary Policy, a research conference sponsored by the Federal Reserve Bank of San Francisco in March of 2015, saying, quote, inflation could, for example, exhibit nonlinear dynamics in which high levels of unemployment place relatively little downward pressure on inflation, but tight labor markets generate marked upward pressure. If so, a decline in unemployment below its natural rate could cause inflation to quickly rise to an undesirable high level. Rapid increases in short-term interest rates to combat such an unwelcome development could, in turn, have adverse effects on financial markets and the broader economy. Okay, so I hope that you're following along here with everything, So you could see, the long run Phillips curve, the vertical curve, okay? And then as people figure out that inflation rises and then they demand more wages and the government tries to push the unemployment rate underneath the natural rate of unemployment, okay? And then it works for a little bit, but then workers figure out that inflation has risen, so they demand more wages. So then wages go up, which puts the unemployment rate back to where it was, but now we have even more inflation, okay? That's what scares the Fed. Now, there it is, guys. I mean, Janet Yellen even said, quote, a decline in unemployment below its natural rate could cause inflation to quickly rise to an undesirable high level. And that's exactly what the Fred chart shows. This theory is simple and elegant and doesn't require the sort of gross fudging I had to do with my actual GDP crossing above potential GDP theory. As such, this is now my leading theory for why Janet Yellen is racing to hike rates. Now, the implications of this are profound. We are already seeing signs of rising inflation in the demand for higher wages in many sectors of our economy. From fast food to retail, wages are on the rise. The Obama administration has even pushed the minimum wage higher. Cities across the country are pushing for higher living wages. This demand for higher wages is precisely what the Phillips curve chart shows happening in an inflation spiral. The implications of this theory are profound, folks, because it means that the Fed is hiking rates not for something silly like, showing the economy has finally gotten strong enough to hike rates. That's why they're doing it. They're going to shore up confidence. See, they're going to say, we're raising rates because things are so much better. No, guys. That has nothing to do with it. The Fed flat out is hiking rates to slow down the economy and to push unemployment back up. Think about it. The Fed is hiking rates because the unemployment rate has dropped underneath the natural unemployment. In other words, they want to increase the unemployment rate so that it rises back above the natural unemployment rate. The Fed is directly targeting the economy with the goal of putting more people out of work. Now, my parallel theory that just works with this so well is that the Fed has moved into a contractionary policy environment and is working with the Obama administration to contract at the fiscal policy level as well. I mentioned this theory in the weekly show several weeks back. This explains why we are seeing the Obama administration put forth fiscal policies that hurt the economy, like rent controls, minimum wage increases, tougher environmental standards, and so on. Higher taxes. Folks, as stock traders, we need to transition our trading into contractionary strategies as well. Remember, never fight the Fed. Trade with the Fed, not against it. On Friday, September 4th, we got the employment situation report. Okay. Now, this is interesting because the way that this dovetails into the natural unemployment rate. Okay. I mean, guys, you got to see this. Okay. So the employment situation report came in at 173,000 jobs created in the month of August, meeting the consensus range of 173,000 to 257,000. The unemployment rate fell 0.2 to 5.1%, which is the lowest of the recovery since April 2008. Average hourly wages are up 0.3% for a 2.2% year-on-year rate. Now, here's the employment situation, payroll employment. And guys, it does not look very good. Okay, you could see, that we're nowhere near growing as fast as we were in 2014. After doing the article, okay, that I posted on my blog about the natural rate of employment, okay, and how the civilian unemployment has crossed below the natural rate of unemployment, and showing you the Fed charts, guess what? Guess what happened? Guess what the Fed did? Guess what the U.S. government did? They lowered the natural rate of unemployment. I kid you not, guys. I kid you not. If you go look at the Fed chart, the exact same Fed chart of the natural rate of unemployment long-term and the civilian unemployment rate that I just showed you, here's the chart, okay, as of September 4th, and look at what they did with the blue line. They pushed the blue line very gradually. You could see this. They pushed the blue line down. So now the unemployment rate is not underneath the natural rate of unemployment anymore. Dude, that is so hilarious, man. That's just so hilarious, these people. Okay? Hey, unemployment rate falls below the natural rate of unemployment? Problem solved. Lower the natural rate of unemployment, silly. Oh, man, no more than 5 days after I wrote my article explaining from a macroeconomics perspective why the Fed is in a rush to raise rates and how the unemployment rate had just crossed below the natural rate of unemployment, they lowered the natural rate of unemployment. Perception is everything, and the Federal Reserve knows this. Okay? In the inflationary spiral diagram that we just looked at, okay, where the stimulative measures only work until workers perceive they are making less because of inflation, and so they demand higher wages, that shows that the concept of adaptive expectations or perception. So guys, don't get too upset about what the Fed does. Okay, we're on to them. Okay, just make sure you tune into my weekly videos. We're on to them, and we know what they're doing. We're following the data and the macroeconomics policy close enough, so we see what they're doing, and they're really not hiding it from us. I mean, obviously they're updating the Fed chart and showing us what they're doing, but don't get too riled up about it, folks, okay? The Fed uses the mainstream financial media and the Fed website to control public perception, which is an integral part of macroeconomics and the bull-bear cycle. Guys, on Sunday, that's when we have to start watching the overnight news cycle, and specifically news coming out of China, okay? We need to start our trading week Sunday night here in the U.S., okay? Now, last Sunday, the Chinese government came out and they said that in an FT interview that they had abandoned measures to boost the stock market. Okay, they just basically gave up after spending as much as $200 billion to try to hold up their stock market. FT News report noted a team comprised of state-owned funds had been active in the market for the last 2 months. Leaders said, too, that they believe that they mishandled the rescue program as too much information became public. Intervention was said to provide a positive market environment on the 70th anniversary of victory against Japan aggression. Authorities will instead focus on investigating institutions that obstructed government measures. Oh, see, there you go, guys. That's why China's so weak. That's why China is no threat to the U.S. Okay? So in other words, China's given up on the stock market. They had these state-owned funds in the market. They spent $200 billion the last 2 months to try to hold up the stock market. They've racked up massive losses. They've given up on it. They said, forget about it. Okay, we were just trying to shore it up as much as we could for the 70th anniversary of the victory against Japan aggression. But now we're going to go after the people that made our markets go down. That's right. We are going to focus on investigating the institutions that obstructed our attempts at pumping $200 billion into the market to make our stock market go up. Oh yeah, it's their fault. It's See, once again, guys, communists, socialists and communists falling back on their big government, their big controlling government, controlling people, getting in people's personal and individual lives. Once again, communists, they can't help it. They have an inferior political and economic system to ours. They're going to go on a witch hunt against these institutions that obstructed their efforts to push up their market. Oh, that's going to work. Anyways, guys, the S&P 500 futures plunged on the news on Sunday night. Check this out, 6:51 p.m. Pacific time in the U.S., okay, California time in the U.S. on Sunday night at 6:51 p.m. Look at what the S&P 500 futures market did. Boom. China's final August manufacturing PMI came in at 47.3. Services came in at 51.5, which was a one-year low. The composite was 48.8. The PMI has now posted below the neutral 50 value for 6 successive months, with the latest deterioration in operating conditions the sharpest since March of 2009, folks. S&P 500 overnight futures plunged on the China PMI report. Here you could see the S&P 500 overnight futures and the big plunge. Chinese manufacturers saw the quickest deterioration in operating conditions for over 6 years in August, according to the latest business survey data. Total new orders and new export business both declined at sharper rates than in July and contributed to the most marked contraction of output since November 2011. On Thursday, September 3rd, the S&P 500 overnight futures dropped again. This time, it was still about China, but this time it was Hong Kong data. Okay, the Hong Kong August PMI came in at 44.4 for its lowest reading since April 2009. Unbelievable. Hong Kong's private sector saw the quickest deterioration in overall operating conditions since the global financial crisis. Okay, unbelievable. Driven in part by steep contractions in both output and new orders. Hong Kong gets a lot of its business from the China mainland. And with China slowing down, Hong Kong is feeling it big time, guys. The latest set of PMI data signaled the new business from mainland China placed at Hong Kong's private sector firms dropped at the sharpest rate since late 2008. And here is the S&P 500 overnight futures, and look at what happened, guys. Look at that. You know, the market was closed, okay, and then it just plunged. So that tells us something. Keep your eyes on China. Okay, Sunday night, make sure to tune into the news and watch China. Now, the IMF came out last week and issued a report to the G20 that said that the China slowdown, among other things, threatens the entire global growth outlook. And that's exactly what our stock markets are telling us, folks. The IMF says that the negative impact of China's slowdown is larger than expected and that downside risks to global growth have increased. The IMF has asked the G20 to take strong, coordinated policy action to raise growth and mitigate risks, and says that Germany should do more. Okay, what a slap in the face to Germany, who has been loaning EU countries billions of dollars that they may never get paid back. Poor Germany. I wouldn't be surprised if Germany leaves the EU. The IMF says that a threat to global growth is the strong U.S. dollar. Exactly. That's something that we have been talking about in these weekly shows for months now. The IMF says that the plunge in Chinese markets should not discourage the China government from reforms. The IMF says that accommodative monetary policy remains essential right now, and warned that leading economies like the U.S. should not hike rates. And folks, on September 1st, the ISM manufacturing number came out, and it was lower than expected. The ISM index came in at 51.1. The consensus range was 51.5 to 54. The 51.1 reading is the slowest rate of growth for the factory sector since May 2013. New orders came in at 51.7, which is one of the slowest rates of monthly growth since April 2013. Backlog orders at 46.5 are in a third month of contraction. New export orders at 46.5 are also in their third straight month of contraction and are at the lowest rate since July 2012. And here is the ISM manufacturing index, and look at that, guys. That looks horrible. It completely rolled over, okay? Heading down, it's taken out the March and April lows, okay? Dead cat bounce, series of lower highs and lower lows. It does not look good, folks. That's a bad looking chart where the March and April lows have been broke so that we have lower highs and lower lows. Rising rates in anticipation of the first rate hike are severely contracting U.S. exports, specifically the rising U.S. dollar. Now, Donald Trump was talking about the U.S. dollar a couple weeks back, and I encourage you to check it out. I will put a link to the Donald Trump video that will appear on your screen right now. And you can click on that link, okay, and it'll open up another page with the Fox Business interview with Donald Trump and what he had to say about the U.S. dollar. Once again, Donald Trump just nailed it. Donald Trump knows what he's talking about, and he knows what's going on. Is he a perfect candidate? No, but who is, right? If you're looking to agree with somebody 100% on everything, you're never going to find it, folks, okay? It's just you're always going to be dissatisfied, okay? I think that Donald Trump, on the things that matter the most to me, like the economy, making America great again, and the stock market, I think Donald Trump is on the money. And he's exactly what we need in the next president. All right, you guys, don't forget to be awesome. Thanks for listening. Love you, and talk with you soon.